Here's the headline in a very newsy set of minutes. Several participants indicated that they would have supported a two-sided description of the committee's future interest rate decisions, reflecting the possibility that upward adjustments could be appropriate. The focus of the January meeting on inflation largely, rather than jobs, and concern that bringing it down had stalled. Officials anticipated inflation would move down this year, but the pace and timing remained uncertain. The continuing rise in prices driven by tariffs, the minutes say. The effects would likely start to diminish this year, and ongoing moderation in housing prices would also help. High productivity growth from technology might also put downward pressure on inflation. And a few participants mentioned that companies were telling them they are automating more operations to try to offset some price increase needs. Most participants, however, cautioned that progress toward the 2% objective might be slower and more uneven than generally expected, and judged that the risk of inflation running persistently above the committee's objective was meaningful. Some cited reports from business contacts expecting to raise prices this year. The labor market, the committee's big concern last year, was less of a concern this year. The vast majority of participants judged, the minutes say, that labor market conditions had been showing some signs of stabilization and that downside risks to the labor market had diminished. Still, most agreed downside risks to the labor market remained in place, particularly as the labor supply diminished. Overall, the economy appeared to be expanding at a solid pace with resilient consumer spending and robust business investment, particularly in technology. Several, though, suggested a lot of that was due to spending by higher income consumers. Lower income spending was soft. There was a long discussion of markets, with several commenting on high asset valuations and historically low credit spreads. Some saw vulnerabilities in AI, including elevated equity valuations and gains concentrated in a small number of companies. Several highlighted concern about the private credit sector, and others commented on risks associated with hedge funds and rising leverage. Finally, the January meeting is when the Open Market Committee elects its officers for the year. Jay Powell, again, named chair of the committee, but the minutes say until the selection of their successors at the first meeting of 2027.
Mike, what is most notable? Because investors seem to be taking this in stride.
Well, this is the first commentary from anybody at the Fed about the possibility of rate increases. Several refers to only 2 or 3 members, and we kind of know who those members might be. But the idea that they did put the idea out there is something that we haven't seen in years, and so it does become a significant talking point as we go forward and watch to see what inflation does. The emphasis clearly shifting to inflation at this meeting from last year's focus on jobs.
Hey, Mike, a couple of the headlines that are worth repeating. Several saw more cuts of inflation declines as expected, yet most cautioned disinflation could be slower than expected. What could lead to slower disinflation?
Well, they're concerned about tariff price increases, and maybe they don't fade out as fast. And then additional demand in the economy, because we're going to get some stimulus from tax refunds, and because of all the spending on AI, might also push prices higher. So there's concerns that inflation, while it may not rise significantly, could stabilize at a higher than desired level, and that might lead the Fed to have to do something about it.
We also had Kevin Hassett out there on a New York Fed tariff study, and I got to ask you about that. He is, of course, President Trump's NEC director, and he says that a New York Fed study showed that the U.S. companies bearing most of the tariff burden is an embarrassment, and the people associated with it should be disciplined. He spoke about this earlier on CNBC. Here's exactly what he had to say. He said what they've done is they put out a conclusion which has created a lot of news that's highly partisan based on an analysis that wouldn't be accepted in a first semester econ class. I've been in that first semester econ class. So, Mike, Fed researchers found nearly 90% of the economic burden from tariffs last year were borne by U.S. companies and consumers. What say you, Mike McKee, and the folks that you talk to, the economic community, who really bears the cost of those tariffs?
companies and consumers in the United States. Mr. Hassett's comments seem to have adopted the attack dog language of the Trump administration much more than even Kevin had done before, maybe because he's not a candidate for Fed chair at this point. But you got to point out that the New York Fed, by saying 90% is picked up by Americans, is the outlier here, because a study by the University of Chicago found 99%, study by the CBO found 95%, the Kiel Institute in Germany found 94%. So all of these people found that Americans are buying 90% or more, are paying 90% or more of the tariffs. So I think Mr. Hassett has looked at it the wrong way, and obviously the Trump administration doesn't like criticism.
Okay, good to have that on the program, Mike. Just before we let you go, the jobless boom, a most read story on the Bloomberg terminal about the unprecedented jobless boom in the U.S., how economists are warning that the U.S. economy is vulnerable to shocks because the labor market is not growing. Some are predicting that economic growth will slow due to stagnant labor markets. Can't productivity increase as a result?
Well, productivity
of technology,
increase,
excuse me, as a result of technology.
Yeah. Well, that can happen. The question is, how fast does the technology get adopted, and how quickly and how deeply does it get adopted to drive productivity significantly higher? The concern about the labor market and the jobless recovery is reflected in these minutes, and members of the Open Market Committee did talk about that as a possibility, a possible risk to the economy. Right. Although, as I said, inflation was sort of their number one concern this time.